thanks a lot for joining this conversation. Today we have Bilal as our guest. Bilal is a prominent CPA with some background specifically in Big Four and now also helping in cybersecurity and tech and
Yes.
overall in IT, which makes him like a really prominent guest for us today. So today's discussion is going to be primarily about personal finances and things that we find our founders to be primarily interested in regards to having startups, but also kind of bringing their own unique set of challenges from because of being from outside the states, sometimes being non-residents and running IT startups. So they usually have a unique set of challenges that we wanted to ask, and we wanted to get some perspective from you specifically, Bilal, as a CPA and as someone with lots of experience in personal finance. Thanks a lot, everyone, for joining today. Just as you know, so Tax Hero is a startup by itself, but ultimately we help other IT companies, specifically with founders that are outside the States, and basically get all their paperwork, financials, and tax-related portions in order. And that's what we have been doing for the past 3 years. And we're happy to have some prominent guests with us. And today we have Bilal. And yeah, and that being said, I guess it's good time to start. So Bilal, well, I would love to give you microphone.
Yeah.
Please let us know about your personal background and how you got into finance and specifically how you got your CPA and yeah, and how you got into tech world. Let's put it that way.
Okay. So I went to University of Texas for my undergrad in Austin, and then after that I went back to Pakistan and worked there for about 5 years with 2 years stint in Dubai in investment banking. And at some point I decided I wanted to do a little more. So I came to George Washington University for my MBA, and I did my MBA in accounting. I sat for CPA. I am a Washington, D.C. and Texas CPA. And then after that, I worked in Big Four, pretty much like I've actually worked in Big Three, so EY, Deloitte, and PwC, and worked mostly in industry for about like 14, 15 years. Extensive knowledge, extensive experience in terms of tax situations and tax for wide variety of industries. And at some point, I wanted to get a little bit flavor of, tech. So I took about 6 months off and went to Rice University for a boot camp in cybersecurity. And I did that for a little bit. Yeah, my totally like understanding of how the tech world works and how already was in the finance world of it. And so I'm uniquely positioned to kind of like talk about both. And I feel like there are a lot of people, I didn't realize there are a lot of people who are looking for that kind of expertise. So thank you for having me here. And I just want to see how I can be of help.
Was it any interesting? Was it any complex? Do you find it boring or it's exciting, interesting? I mean,
Okay. So yeah,
for someone, go
yeah,
ahead.
this is interesting. I do like working with people. It's really nice because when you talk to them, you kind of understand their whole journey, what has started and where it has led them to. So by the time people come to me, they have already had a journey of about a year, year and a half, whatever, as a startup founder, right? Like from ideation of an idea to putting it on paper, to kind of putting it into action. So by the time they're there, it's already in action. And so for me, it's exciting to know what the journey is, what people are trying to do. And for me, it's really interesting, like how they can make a difference. The tax world is kind of a modern bunch of rules, and I want to be there, to help people out while navigating through the rules. So that's how I find it exciting, and I'm surprised how many people have actually reached out to me just because I'm a CPA. And so I think those conversations would not have happened if I was not a CPA. So I think that's what makes it really interesting.
Got it. Well, good to know. Good to know. Awesome. And in terms of like what type of companies that you had to help while working in Big Four, was there like was it like more complex type of accounting? Did you actually get to help like smaller guys and like smaller startups overall? Was it how was it?
Yeah. So in Big Four, you don't see smaller, companies. They are always like corporates because the billable for a Big Four is kind of there for people who are already making large amounts of money and they have a lot more complex issues. Simpler people, for simpler startup, when it starts, the issues are much simpler and they're not as expensive as someone who's making like $10 million, like, have a $3 million tax bill versus someone who is like just starting and making losses. So it's a different perspective. But me running my own private practice has kind of opened doors for me to do smaller people. And then I worked with Intuit, which is basically doing TurboTax. And when I did CPA, I was able to reach out and like see a lot of these smaller startup founders. I probably ended up doing like in a busy season about 1,000 returns in a busy season, which is like 3 or 4 months. Like we're talking about January to May, even though people think that April 15th is the deadline, but sometimes it's an October 15th deadline. And so people kind of stretch it out till May. So I was able to see a lot of those smaller returns. And it's just interesting how people are into trouble for some of the things. And so it's interesting to see those issues that normally a startup founder would see.
No, that's interesting. That's interesting perspective. And so, tell us a little bit more about your private practice then. Like how, like when did you start it, and how, like what happened?
So I got laid off in 2016. And so I didn't want it to depend on just one set of income. So I decided I'm just going to go and start my own private practice. I'm not going to take many clients. And so interestingly enough, my first client was a guy who was starting a hydroponics farm. So I don't know if you are aware of how a hydroponics works. Is basically it's a greenhouse and they have like a reservoir with fish and they use the fish waste to irrigate plants and like grow, fertilize. They use the fish waste to fertilize a lot of fruits, vegetables, and so it's a kind of a circuit where like the water flows through a lot of these plant beds, and in theory, when it comes back into the reservoir again, the water should be clean because the plant roots would have taken the nutrients. So that was my first client actually.
Mhm,
And it was
mhm.
interesting to see because farming is something that I didn't know. I had no clue about it, but it was like farming and high tech, kind of like that industry. And it was a smaller guy, a startup, and it was probably they ended up spending like about $150,000. It did not run the way it should have run because of internal wranglings between the partners, but it did give me perspective on how businesses go, like what should be looked at. So for my first case was like something that was very, very forward looking, but did not work out because of the founders. But it was an interesting business problem they were trying to resolve, which was basically getting what I call truly organic vegetables out in the market for a lower price. And I think that's like something that more people like should go, and that kind of inspired me to look at ideas that are difficult to pull off but are inspiring for the rest of the world because they can make a difference.
Yeah, that's so true. That's so true. And that being said, actually, like I have a first question in regards to taxes, I guess. Do you think taxation for startups is somewhat different than it should be for any other, specifically like IT type of startup, like Silicon Valley type of startups? Do you think it's any different from like a typical tax return that like a small business has to file?
Yeah, I mean, in terms of if you're talking about differences, yes, because a typical Silicon Valley startup will have zero revenue and will have tons of cost, right? So at that point in time, you have to think about like what costs to expense, which basically means you can take it that year, or which ones to capitalize, which means you take it over a number of years, you know? And so kind of coming out with a way of if you're developing a software, how do you capitalize that software? So at that point in time, is it necessary to go for R&D tax credit? No, because the company is not making money. But if they're making money, then you can probably go for R&D tax credit or some of the other credits that are available. So it really depends, like what it is. A lot of Silicon Valley startups start with zero revenue for a couple of years, but some of them I have seen have actually come out with. I'm not saying they are making profits, but they are making revenue right from day one. So it really depends on the situation.
Right. And so basically optimizing your expenses and making, because startups
Agree,
are
agree.
generally,
Yes.
there's generally non-profit, like they're basically losing money and it's not even in question. So basically making sure that you utilize your expenses and utilize your losses to as much and as long as possible. That's basically, is that the
Agree.
primary objective?
Agree.
Got it.
And that's why we kind of like it gets into a really interesting situation where you're looking at what kind of structure should I be looking at to optimize taking the expenses. If not today, tomorrow, because you're always forward looking. Because at some point you have to start making money, right? So that's
Yeah.
something that is important for startups. And I think it's important for startups to know their burn rate, and it's important for the startups to know when they can start looking at a revenue coming in. So those are two things that people should always be doing. They do have an effect on taxes, but it also works towards the survivability of a business.
Yeah, absolutely. So not just like a typical CPA perspective, but more of like a CFO perspective, like making sure that you're
Yes.
like on top.
Yes.
Got it. Got it. Great point. Great point. I have another question then. I'm just kind of like a continuation of the previous one. So startups tend to be, so what's interesting about startups? So they tend to be in Silicon Valley, but they tend to be registered in Delaware. Like that's just the reality of it, right?
Yes.
So does it like how much complexity does it add to a startup? Well, like accounting
So
from accounting perspective.
So this is more like I can answer that question, but from a tax perspective, but it's more of a law question. Why do
Hmm.
people register in Delaware? It's just a standard because Delaware has very clear guidelines in terms of corporate governance and corporate business, like tax law. And corporate law is very, very defined in Delaware. That's why people do that. But lately, I have seen some companies that are in tech space, mostly in fintech, going to Wyoming. And the reason for going to Wyoming is they have clear rules, corporate rules in the Wyoming jurisdiction. Because when you register a company in that state, you're abiding by their laws, which are the state laws, whatever they are. And so that's why people kind of avoid, let's say, New York, which are more complex, than Delaware, which have less complexity. I'm not saying there is absence of complexity, less complexity than some of the other states like California and New York. The downside for Delaware is then you have to pay a fixed franchise fee or state fee, and that's if it's not that much in grand scheme of things, but it's enough for some people to bother. That bothers them because it's like you're paying without making any money. So if that is the case, then you should be looking at maybe other states. Texas is a good state. Texas charges taxes based on the percentage of revenue you make, and you are exempt up till 2.2, approximately $2.2 million of revenue. And the corporate governance here is very clear and well defined. So a lot of companies are now moving to Texas and forming their companies here. But Delaware is not a big. Delaware is still the go-to place because the complexity of tax regulations and corporate regulations are not as much as some of the other states.
Yeah, but my question would be then mostly about, but they do operate in California, so they would be registered in like they would be registered as a foreign company in California. So like
Yes, 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 yes. But you do it because Delaware has defined, and then when you go on to California, you are only paying taxes from revenue originating from California, and rest of the taxes are like rest of the revenue is not taxed. Like you're not gonna get taxed on it. I
got
mean,
it.
to simplify,
Yeah,
I'm overly simplifying the situation at this point, right?
yeah,
But the reason people do it in California is when they know they are going to start making money in California is when they register as a foreign corp and then start, but Delaware, you do it because of the clarity in your core. For instance, you get, let's hypothetically, I'm assuming, let's say if you're a healthcare tech, fintech, right? Like tomorrow you get into a lawsuit. It's just hypothetical, okay? When they have to go, when if somebody sues you, they have to do under the laws and regulations of Delaware and not California. So I think that jurisdiction matters.
got it. Yeah, I mean that's totally the case. Well, good to understand. So that being said, as you know, most of our customers and lots of them actually have foreign founders, but they have
Yes.
startups in the States. And when someone is out from outside the States, well, first of all, let's actually get to it. Like, is it much more complicated to file taxes if the founder is from abroad, from not from the States?
I think like it's not more complex than any other tax returns. From my perspective, there is complexity. I think the biggest complexity is because there are a lot of founders that are abroad and they need the tax identification number. So for the first year or so, we have difficulty because we have to file a tax return, which is without a tax, but it's not any complex. It is complex. I won't lie. It is complex depending on the situation because a lot of foreign founders, they are working in United States with their companies trying to sell here, but they're also doing a lot of their operations outside. So yes, there's complexity. There's definitely complexity of the amount of activities. And so it makes it really hard sometimes to see like what would be taxable in United States and what would not be taxable in United States. And I think that's where, so you're correctly pointing out where is the complexity coming from. The complexity is coming from the activities of a founder. Now the problem is for tax person is we are looking always retrospectively, right? We don't look forward, we look backwards. And most of the time when people are coming to me, they've already done their activities a year out or a year and a half out, right? So let's say if you're doing, let's say your year end, let's say 25, right? By the time somebody comes to me, it's like better part of 26. And so trying to recreate what happened and trying to figure out what was going on creates a lot of friction in terms of information that should be shown on the return and what really happened. And I think reconciling the reality and what would go on the tax return creates a
Uh-huh.
lot of complexity.
Got it. And so here's an example, just like you said. So we do have customers sometimes that come to us and they're startup founders, very passionate about their product and so on, but they're very, how to say, like, they can be sloppy about their taxes stuff. So they can be
Yes.
passionate about their startup, but sloppy about their taxes. And there's one specific form called 5472, I believe. That's the
Yes,
one
yes,
that
yes,
foreign
yes.
founders file. So we had one customer who actually got fined by the IRS for $20,000 for
Yes,
missing
yes.
to file that, or filing it
25,000.
late. 25,000. Yeah. So that's an insane kind of like fine if you think about it. It's much higher than any risk that the founder would even
So for
calculate.
most, yeah, most founders, like you can talk to them, and most times IRS actually waives the 5472. But the point is that if you're doing 5472, the reason it gets worse is because 72 is auto generated. And if you don't have extension in place, they will charge you. So let's say if you don't, I'm hypothetically saying, let's say you didn't file an extension and you file on the 16th of April, they're going to send you a $25,000 bill. Okay. It's auto generated if you don't have an extension. But let's say you have an extension, you have till 15th of October to kind of do what you need to do. So in this case, the extension is very important, regardless of what will happen on 5472. You need to file in your extensions right away, and then go from there. That's my recommendation to everybody, is like, please put in your recommendation as soon as IRS opens this year on 24th of January, I think. We'll see. Because of the government shutdown, I'm not saying like what that date is going to be, but I think it's opening in the third week of January right now.
Mm-hmm.
I think like we should, the day it opens, you should just be like, I have to file these returns anyways. Let's just file. If I have to file a 5472, just get an extension and then take your time.
So, wow, so that's good. So even if you have deadlines and if you're planning on keeping the deadlines, just file it just in case.
Just file the
Just
return.
file
Just file. Don't file the return.
the
Just file the
extension.
extension. Yes,
File
just
the
file the
extension.
extension, and that will, at least you will not. Because I have other clients. I have a client who got pasted with $25,000, and I'm fighting that war right now. Twice, because it was a weird situation, and we'll see what happens. I have sent my letter. I'm still waiting for processing. It's been 6 months. We'll see what happens. So I'm saying is like it takes time. It's not an easy process. That's why you should talk to a CPA, so you don't have to go through that, not only the burden but the angst of like dealing with IRS for that penalty. So that's why I am always recommending like, hey, if you don't want to talk to a CPA, at least file an extension
Got it.
to avoid this
Good
problem.
to know. Yes, yes, definitely good thing to know. My another question. So if we actually continue with this conversation, so those are about federal taxes, but they're like complexity also comes with in the United States comes with having to file state taxes as well, and then sometimes
Yes.
in multiple places. But if we talk about just about Delaware startups, so they have this thing called franchise tax. And the franchise
Yes.
tax is based on assets, or sometimes it can be based on stocks and stuff. And there's a fixed, like a minimum type of fee, but it's usually due on March 1st.
Yes.
Is there anything that you would want founders to kind of like keep in mind when they file franchise taxes?
I think like the founders need to make sure that they file it on time, because if you don't file it on time, then it goes into what is called like kind of like abandonment of your structure, which means then that structure is not in place. So
Mm-hmm.
it's better that you fulfill the deadline and just file, pay the money, the minimum, because most startups don't make enough to go for the higher. You will be paying the fixed fee for the most. I think like 90% of the founders, even more, like 95% of the founders that are like I have seen in my career, and I have seen a lot, they end up paying the minimum fee. So you might as well pay. Otherwise, like they move very fast to close your LLC. And so that's why we should just avoid that situation.
Got it. And but overall, like a smaller startups, they have like a fixed fee. At what point
Yes.
they have to file? At what point they have to file not the franchise tax, but like the Delaware state tax return?
Depends. It really depends. Like definitely start you have to start filing once you start making revenue inside United States. Because
Uh-huh.
what can happen is you can have a Delaware company, but your most of your revenue is maybe outside of United States. So it should be covered under 5472, for international operations, but it's not gonna be relevant for Delaware taxes. But if you start making money inside United States, that's when it comes into
Got it. Specifically Delaware taxes, not the federal
Delaware
ones, right?
taxes. Yes, we are specifically talking about state taxes at this point.
Uh-huh. Got it. But Delaware tend to be a little bit on the kind of like old school type of way, don't you think? Like they're really type of like still faxing and sending scans and email and stuff.
Yes.
How do you tend to troubleshoot those problems when they arise with the state specifically?
Well, first of all, I try to go to their website and try to figure that out. First of all, you talk, okay, so there is a methodology to this madness. First, you talk to the founder, ask them what exactly happened, right? Then the second is you try to verify it against what has actually happened inside Delaware. Sometimes you talk with the person, with the agent, and see what has gone. And you try to then reconcile both of them and then try to come out with a solution to resolve this problem. And if you give me a specific problem, I can talk about it, but most problems are mostly like people did not pay the minimum tax. That's the most problem that startup founders have, because they forgot or they were not aware of the deadline. So I think the first thing is to be aware of the deadline,
Hmm.
because Delaware will charge you fixed fee regardless of you make zero money or you make 100,000. They will charge you that fixed.
Yeah, yeah, yeah. Here's an example. We had one company that they had an LLP, and there's a
Sure.
different deadline for LLPs in
Yes, yes.
Delaware, and there's a then for the C corps, and or was it the vice versa? But basically, they missed the deadline, and then when they went online, it basically had them like late fee, and
Yes.
then deactivated. The actual company
It's,
deactivated, so
it's
they
called
had to
forfeiture.
call.
Yeah, it's closed forfeiture. Yeah.
Yeah, and they had to revive the company. So what would be
Yes.
the typical thing that the CPA would do? Do you think that the CPA is needed in that specific case, or the founder can actually kind of get it done by himself?
My perspective, like a founder can do it, it's just too much of wrangling like you have to do, because you have to call from, it's kind of expensive to call from outside of United States to in and kind of figure this out. And most of the time they are looking for faxes. So a CPA, yes, a founder can do it, but they will end up spending a lot more time, and probably like they will end up paying more money, versus like a CPA who can have a conversation, maybe reduce your fee and get the forfeitures. I deal with forfeitures all the time in Texas, and it's such a convoluted, complex issue that even it takes me time to do it, because sometimes like they close it and they don't even tell you. Then you have to figure it out. You have to take the forms, you have to fax them, you have to keep communicating with them till it gets into reinstate. So to kind of backing on your conversation, I would recommend just abide by the deadlines, just pay the fixed fee. Sometimes, like if you're opening in Delaware, that fixed fee, just pay it. Otherwise, they'll forfeiture, because opening it back again is going to cost you double with penalties and interest. So might as well just
Mhm.
pay it. And Delaware's penalties and interest are very hefty. Like I think, like if let's say this is just, I don't remember what the fixed fee is. Let's say it's $200. You end up paying $250 in penalties, interest, and all of that. Good stuff. Not to mention additional money to just reinstate the entity itself. And so it takes like, sometimes it's even better to just like open a new entity, because it's like so much more expensive to you know
Yeah, to fix
I'm
to
not
fix the problems that you created.
to fix the problem. I'm not recommending that. I'm just trying to tell you like how much of a hassle, not like for a client to let go past the deadline, end up paying more money, going through more pain, and then paying for the CPA to kind of resolve the situation. It's better off just pay it all outright right away, because it's just going to cost you a lot more expensive and it's going to be a lot more hassle.
Got it. Well, now let's actually move to other states. So let's say you are registered in Delaware, and because
Yes.
all of the startups that we have and we kind of target them, most of them are actually in Delaware, but they can be operating in other states, or they can have employees in other states. Like they can have
Exactly.
employees in Virginia, they can have
Yes.
employees in California. So what's needed, what needs to get done in that specific situation? So what do founders need to be aware of? Do they need to file taxes in that specific state, whether it's payroll taxes or it's income, like a tax, like corporate income tax or return, or like what needs, like what they need to kind of keep an eye
Be
on.
aware. Yeah, yeah. Okay.
Yeah, be aware
So
of.
from a perspective of a startup, you don't right away start with 50 states. Normally, it's like a couple of states, right? So there is a term in state and local taxes called nexus. The concept of nexus is like how much business you do in that state before you become, before you have to set yourself up. Now it
Hmm.
could just be like maybe a single employee, or maybe just like you made a sale of 35, $40,000. So each state is different, but most of the time there's like a consistent rule about, I think like it's 50,000. So for instance, I was working for a very renowned forklift trucks, and for them, they only have to sell one truck to start filing return in that state, because they're each I think their each truck is like about $50,000. So like literally, they're just like they sell one truck, they have to start, or if you have like let's say one or two employees, then you have to start doing all the compliance work because you have nexus in there. So again,
Right.
it really depends what exactly is going on, because like sometimes the nexus happens because you're there, like because you have employees there. Sometimes you have sales there. Sometimes you have a permanent establishment, which means there's an office there, right? So it
Uh-huh.
really depends what exactly is going on, like what exactly is going on in that organization. So it's very case to case
Got
basis.
it. Totally makes sense. Totally makes sense. And complexity comes in. So I have another question here then. So let's kind of dive into more like federal taxes at this point.
Sure, sure, sure.
Like, what do you need to? And this is a basic thing, I think. But why do you believe startups or companies are required to file taxes even though they do not make money? Like, let's say they make zero money or they have no operations. And why did federal government kind of like enforce them to do that? Like, in your opinion?
Actually, that's a very good question. I think this is, if you're a startup and you're at the end of the day, your mind is, I'm going to start catering to US markets, right? To sell your product or whatever, right? Like that's, you wouldn't be here if you did not see United States as a way of like, doing business in this country. Now, the reason you want to file taxes is because initially you're going to have losses. You want to preserve those losses so you can use those losses to offset profits in the future.
Right.
And that's what you should be, that's where the optimization of tax comes into play. And so yes, companies can go about doing their without filing taxes, hypothetically, right? But then you will be losing out on all the losses, which are future benefits. You will be losing out on that if you did not file taxes. And then also, it doesn't, a business in reality does not exist if it has not filed tax returns. And so investors will not take you seriously. Now that's taking me from tax perspective to a CFO perspective, which is I have to
Right.
file taxes to show people that I'm a serious business and I have everything complete. I have presence in this country and I'm doing work that will create future benefit. That's why you should be filing taxes.
No, that definitely makes sense. And well, here's the question then. That's kind of like going from that. Startups, as we just discussed at the very beginning, they lose lots of money upfront. Like they actually
Yes.
lose money for years and before they actually start making profit. And they
Yes.
usually burn lots of investors' money. So what
Yes.
happened is that, I mean, today most of the founders raise on what's called safe notes and some convertible notes early on, right? So they basically accumulate debt, which is not income.
Yes. Yes.
But some founders, and we found like we saw a few, tend to be a little bit, how to say, not strategic about it. And they basically raise money on what's called on equity. Basically, they get them on their cap table, funds on cap table. And that brings so much more complexity to their tax return. Can you elaborate on
Yes.
that? Why does it bring complexity? How startups should avoid it and why they should avoid it?
I
Basically,
think like,
raising on equity rounds.
so when you're doing the equity run, equity does not have a tax perspective, right? When you are actually raising equity, you're doing it on a valuation, right? Like when you are raising
Right.
equity. So there are two kinds. So we have to go step back a little bit. There are only few ways to do it, right? Either you have your personal money, right, involved in there. That's different, right? Then there is loans you take from the investors, right? Then you have loans. Then you have equity, and then equity have classes. The reason you should like, I mean, the reason you should look at compliance is to see like if the equity, like the nature of the equity is changing. Is it going from like, not voting to non-voting? Is it diluting? If it's tax, if it's preferred? Like, when do you start paying out dividends? So like from a tax perspective, dividends are the ones that actually create situation, because dividends are taxable. Okay. And they're And then that's why they say, like, if you're a C Corp, it's double taxes, because like you pay taxes on the money that you're making, but then you are also paying dividends as an investor. So it depends on whose perspective are you looking at. If you're looking at from the perspective of, let's say, the startup founder, you should keep your capital structure as simple as possible. If you're creating a loan, then loan means that you're going to have interest. And we have interest limitations because there is a specific formula that you follow. So not all interest can be not all interest can be expense. Some of the interest might has to be capitalized. So there's complexity in the interest that you're paying, right? Like from on a loan. And if you're, let's say, paying, if you're, I feel if you have like more of shares, like, capital shares, then the complexity is less because you know exactly how it looks like. And that complexity of shares, the complexity of taxes on those shares shifts to the investor, because once they sell it to someone else, they have capital gains. And so that problem goes, it's not on the founder. So it literally depends on what structure you are on, how you are raising the money. If it's dividends, there's a different tax implication. If you have a loan, then there's a different implication. So it really depends. But if I am like a person, like, I would recommend investors to keep your capital structure as simplified as possible initially.
No, that's actually a good point, because when we see a startup that actually had raised some equity early on before even making like huge profits or like a big valuation, that's a red flag. It's like, oh, probably the founder doesn't like made a mistake early on. That's objectively a mistake. I have another question though. Let's actually kind of jump. So what I'm trying to do here is basically bring some questions or some situations where things become a little bit more complex. So there's one thing that really interests me. Well, in IT world, lots of founders are actually working from home, but they cannot deduct their, or they can have remote, what's called the remote teams,
Yes.
and then they need to start deducting their office expense.
Yes.
And we've seen lots of situations where founders are not sure how much they can deduct, how much of their home expense they can deduct, and so on. So what's your opinion on this?
It really depends on how you want. Home expense is not normally available on C Corp. So if you want to do it, like, it's kind of a complex way of doing on a C Corp, where you have to have figure out, like, okay, what part of, home expense do you want to allocate to C Corp? So it gets into all these rules and you have to figure out what would actually work. And so the cost of overhead on a client increases because CPA would actually have to go in and figure out, okay, what kind of home expenses there are, how much of that percentage can go towards the business. And so that's where the complexity arises. And so normally the best way to kind of avoid this is have like co-working space and altogether avoid that problem.
Got it.
Because
And
let me tell you an example, like let's say things like mileage that are available on schedule C, for individual smaller self-employed people, is not available for a C Corp, because C Corp you have to take automobile expenses in actuality. And that's the problem we see in home office problem as well. So home office is something that is very, very complex and has to be seen, and it's very much case to case basis.
got it. And then it brings lots of complexity into it. But if the
Yes.
founder is actually, but if the founder is actually abroad and he got to, let's say, California for a business trip, ultimately to meet investors and so on for months, and then he leases the apartment. So that apartment is ultimately the rent travel expense. What would that be?
That's a travel expense. Not an office expense. So you have to understand travel expenses are separate from office expenses. So you have to do those determinations.
No, that's
And
actually a very
yes,
good
if
point.
you are doing and if you are making travel expenses in the course of business, yes, they are legitimately deductible for the most part. Just have to be seen what kind of travel expenses are we looking at. So for instance, like if you're looking to go abroad for a vacation, but you were also going to meet, investors, you were already going there for vacation. And so trying to put it as a legitimate travel expense for business is really hard for IRS. And then you have to, and so I would recommend that, highly recommend people who are definitely like, founders, to avoid this situation. If they are going for business to meet investors, keep it strictly business. Don't mix your pleasure or vacation with business. And it makes it easier. I think like it will be easier for them to justify their expense.
And so yeah, home office is a lot like a big problem that we see. Another thing is we see a lot is specifically with our startups is that they have lots of their contractors outside the states as well, and they wanted
Yes.
the money or they have to pay for the software. Is there
Yes.
things that they need to keep an eye on, specifically when
I
they
think
do that?
so. We are going to move back a little bit before, and which is I know we didn't even talk about it, which is bookkeeping. I think it's important for accounting to be solid, and whenever you're paying your contractors, you have to have like some level of contracts that are already like in place. Like let's say if I hire a programmer, just have a standardized contract, and then a trail of income, a trail of payment being made to the contractor from the bank account. So accounting is very important, and it should be, because at the end of the day, if IRS audits, they're going to go by your books. So your books need to be rock solid. That's that, and that will kind of reduce the problems that you're looking at.
Totally makes sense. Totally makes sense. But overall, that's doable and that's possible, and they should keep an eye
Yes,
on it.
yes, yes, yes. I'm just talking about like how you want to make it doable, possible, and less painful for you.
Right, absolutely. So, what if they have to? What if some founders they make uh, personal expenses on a business card? So that's a
I
question
think
number
like
one. And vice versa,
yeah,
they have business expenses on a personal card. So what should be? I mean, it's a thing that they should ultimately avoid. But if that happens, what needs to get done there?
and I will recommend, and I will recommend it always have a separate business account. Just have a business account, do all your expenses there. If you have to give money to yourself, obviously you can do a drawing, but then that's a complexity we have to see, like what kind of drawings are you doing, like income, what form of income are you taking? Are you taking it in dividends? Are you taking it as like let's say salary? So I mean there are complexities to that, right?
Hmm.
But yes, it's doable. If you have to do drawing, like having a centralized dedicated business account for a business helps in accounting better for things and reduce the audit risk, or at least if the audit happens, it will become much more quicker if it's clear that it's coming from business rather than like, because if you intermingle these personal and business, it becomes really hard to kind of separate the two, and
Got it.
it increases problems for IRS, it increases problems for you, so you want to be as clear as possible. So I would recommend just sort simplicity for yourself.
One thing that we also found a lot, and that happens a lot with our founders, is that they do not even know how to address problems, and then they will be ready, like they're basically from outside the states. The only thing they have in the states is their business, and they file business taxes. But what if they have to do something personal, and they do not live in the states, they haven't been in the states, or they are outside the states at the moment? Would that their tax process be different from any?
You can apply for ITIN, not Social Security. Social Security is now being restricted. Years ago, you can do that, but not anymore. They give you what is called an ITIN, and the process is very simplified. You have to get a tax return, an empty tax return, which basically means like a tax return at 1040 NR, and have the what you call apostille, which basically means like documents of your passport and like your presence in US, and send it out to IRS, and hopefully they should send you an ITIN back to you.
Good. On that note, well, thanks Bilal a lot for giving us like a call today, or basically jumping on this call. And if you have anything to share with the team, if you guys need a consultation with Bilal and his CPA firm, feel free to reach out. Is there anything special that you want to add to this? Maybe you have some specific office hours or something.
Absolutely. I love working with you. Thank you so much for having me here, and I look forward to a next call.